Welcome to the latest edition of our virtual investor series. My name is Susanne Matern and I'm responsible for the European Structured Finance Analytical team. Today I'm joined by Matthias Neugebauer, the head of our EMEA CLO or Structured Credit team, and we are going to discuss the impact of the current weakening economic environment on CLOs. So Matthias, we have rising interest rates, high inflation, weakening demand for corporates and the war in Ukraine. What does that mean for CLOs in terms of their performance?
Well, it doesn't bode well, of course. But the good thing is we have a fairly good starting position. The portfolio this year has been overwhelmingly stable. The CCC share is very low at 4%. And a lot of the corporate issuers were able in 21, which was a record year, to extend maturities and lock in lower spreads to the extent that we don't really have any meaningful maturities coming due. So in 2023, it's less than 1%. In 24, less than 10%. So there's no immediate refinancing risk for corporate or for the issuers in the European CLO portfolios. However, it's all about liquidity, right? So the factors that you outlined, the higher inflation, the lower growth, will all compress margins, EBITDA, increase leverage, and put pressure on interest coverage ratios. So far, we have not seen that happen yet. So the second quarter earnings reports showed that demand held up well, also in consumer discretionaries. But that's only a matter of time. The cost of living crisis is going to bite there. And we expect that basically demand will decline for the rest of 2022 and in 2023. And we've done a stress test whereby we looked at, or the corporate team looked at, how well corporates are set up to absorb a rise in base rates, for example. So the current situation is relatively good. The interest cover is holding up, and even 300 basis points increase in Euribor could be absorbed with more than 3/4 of the corporates having coverage than more than 1.5 times of their interest expenses.
Now, following on from that, given our CLO methodology, CLOs have some headroom that protects them in a deteriorating environment, protects them from downgrades through the stress portfolio analysis. Now, I guess we are expecting a deteriorating credit profile for the underlying corporates. So how much could that be? How much defaults or downwards rating migrations could we see before it becomes a problem for rated CLO notes?
Yeah, that is true. CLOs have headroom just by the fact that they are a managed fund product. So they are subject to portfolio profile tests, collateral quality tests, and such as the weighted average rating factor, VaR, spread. And the managers tend to keep headroom when a transaction is structured. A lot of deals were reset, refied in 2021 owing to the environment then. And new deals were also issued relatively clean. So a lot of that headroom is present. So it ranges between 1 and 3 notches because the way we look at transactions when it comes to performance deterioration is based on the actual portfolio, not on the covenants. So the headroom is owed to the fact the difference between the covenants and the actual portfolio, which is better than the covenants. So we run a stress test where we took a recent publication from our corporates team. They looked at the exposure of various sectors to the stagflation environment. They tested the interest expenses, so this liquidity stress that I mentioned before, and reported their findings. We translated that into migration and defaults. So we run a stressed test on 30% migration, so 30% of the issuers notched down by 1. Plus, we took not their base case default forecast, but actually their stressed forecast for 23 at 5%.
The base case is still 2.5?
The base case is still 2.5, correct. And we see that most ratings, or the overwhelming share of the portfolio, would be stable under this scenario. And of course, the headroom is somewhat reduced, but also the large part of the rated tranches would retain headroom between 1 and 2 notches. So the headroom that is present could absorb that scenario.
That is for all rating levels, AAA down to single B?
That's for the entire capital structure from top to bottom. We run a second scenario, which we termed a severe scenario, triggered by the same macroeconomic stagflation environment. That is where we assumed everything gets notched down by 1, and we doubled the defaults to 10%. And even in that scenario, a lot of the tranches, about 2/3 of the tranches would retain their rating and some cushion as well. But that scenario shows that there is dispersion in the performance of CLOs. We also see about 20% of the transactional tranches would lose their rating under that scenario. And it varies across the portfolio. So in particular, transactions out of reinvestment, static transactions, or the transactions that were recently brought this year, or to the higher cost of capital, for example, have less headroom because they have less stringent covenants relative to their current portfolio.
So these are the more vulnerable, but overall a very strong picture in terms of rating stability, or at least limited downwards rating migration on
Correct.
the CLO side. Okay, thank you. Thanks a lot for your insights. And thank you for joining us. For more information on European leveraged loans and CLOs, please visit us at fitchratings.com. And if you do have any questions on the topics we discussed, please send an email to the address on the screen.